Hello, everybody. Welcome to Friday. It's the last day of the trading year here, and I'm wearing a green shirt, even though the market was down today. So the market was down 0.3%, but this is a green shirt year. Really fantastic year altogether. S&P 500 ended up 24.2% up for the year, which is really incredible, especially considering what people thought was going to happen. Even Chairman Powell, the head of the Federal Reserve, this week was speaking, saying how many of the analysts, even on the Federal Reserve, economic staff and what have you, were wrong about what was going to happen this year. And so I think there's some things to learn. So I just want to talk a little bit, sort of a year in review, in the guise of, what did we learn this year that we can use going forward, to be better investors. That's what this channel is really all about, at least this part of it. So I think the key things really kind of go back to the beginning. Number one, you got to have some positive information to go with the negative. There was just a deluge of negative information second half of last year, first half of this year, just everybody talking about how things were going to fall apart. I got so many emails forwarded to me from clients asking me what I thought about these, negative situations that were being, put into these emails. And of course, we've talked before that, negative sells. Fear is a really strong emotion. And so people tend to click on things and read things when they are presented something that makes them fearful. But I think to be a good investor, you have to be balanced. And so if you think back to the beginning of this channel, when I first started doing these daily bits on the market, it was the 22nd of March, 2020. So, the pandemic was in full swing here, at least in San Jose. We'd been locked down and, lots of fear within the clients, had kind of a physical fear and a financial fear. And so I sat down and I wanted to record some of the positive things that I saw happening, just to kind of balance all the other things. People were talking about the next Great Depression and what have you. And I was talking about the interest rates being at zero and bond market, skyrocketing up in value, and Congress, pouring money out the door. Turns out that all of those things in the end made for a really strong stock market for quite a few years there. And I still think that's true this year. You had to be able to see, the consumer spending still going well. Gross domestic product was doing quite decent and then got even better as the year went on. Company earnings were better than expected, not spectacular, but better than expected. And still doing quite well. Never had that big fall off in earnings that everybody was talking about happening because of interest rates coming up. Turns out that, companies that already refinanced at this lower rates, households that are refinanced at those lower rates, and even though rates were coming up, it didn't impact companies as much as was expected at that point in time. So again, keeping a balance, kind of on the positive side. And that's what I do on this channel. Now, it doesn't mean I don't pay attention to the negative side, because it is important, but I do try to present this positive piece so that everybody can kind of have some ideas. So I think another thing that we learned this year is that you really don't want to invest against the trend. In other words, market starts to come down, but we're in a primary uptrend. You don't want to run for the hills, pull your money out, put it into CDs, even if they're paying 5%, just because, if the trend is still intact and we're still in a primary uptrend, you want to ride that until you're not in that primary uptrend anymore. So this year, for example, we entered a primary uptrend based on my measures late January, early February of this year. And we stayed invested all the way through on the stock market. Even though we had a 10% downturn from the end of July to the end of October, it still hadn't violated the primary trend. And so we stayed in there and continued to, make money here in this fourth quarter, which turned out to be unbelievable. So, we had, I think, that is super important. Positive, invest with the primary trend and stay there. Maybe you make some changes, maybe you get a little bit more defensive, those types of things, but stay invested as much as possible, because things can turn around so rapidly. If you're not invested, you could miss out. And that was true in this particular run up that we're involved in right now. Ended up with a phenomenal beginning to that. If you missed the first few days, you missed probably about 5-6% of the run. So better to be in there as far as that goes. The second thing is when Silicon Valley Bank went out of business, Signature Bank and First Republic and all these banks having trouble because of the bond values in their portfolio decreasing. rapidly in one of the worst bond markets we've ever had. And they had to have a mark to market concept now. So in other words, used to be they could just call the bond, $1,000 bond, and it was worth $1,000. And then they started a thing called marking to market, where they had to actually put it down what it was actually worth right now, even if it was going to be $1,000 when it comes due. So if it's worth 700 now, you've just lost $300, at least in paper, until it comes due. And so these banks were having to run out and gather capital and, try to, shore up this hole. And, people started worrying about, why is this bank trying to gather capital? And boom, in today's world, you've got a business very rapidly in a bank with all these, electronic avenues for removing and moving money. But the government stepped up and put together a special program that allowed the banks to give those bonds as collateral at their actual value at maturity, what they call par value. So say $1,000. They're mostly government bonds. They had to be high quality bonds, and the government would give them 1,000, even though they're only worth 700 now. Government waits until it comes due. And so it was brilliant. There was $154 billion borrowed in that particular program just the first couple of days, and really kind of settled things down, as well as the government stepping up and saying that they were going to backstop, depositors, even if you had more than 250,000 in some of those banks. So I thought that was very interesting. And what's really important to understand about that is that's a theme that started in 2008, where when things start to come apart, the government steps in with some money, basically, and tries to fix those things. They let Lehman Brothers fail. And this is what really has been driving people all the way through this. Rates went up and up and up. We started a recession. Lehman Brothers fails, and we lose another 30% of market value. That's what everybody was expecting to happen this year. And that's exactly what did happen. Silicon Valley Bank, went out of business. But instead of letting, Lehman go out of business, in essence, in this case, they didn't. Because last time that happened, you ended up with a regime change. You had a Republican president, and all of a sudden we had a Democrat House, Senate, and White House as that happened. So here we are heading into presidential election, and both parties have realized that this is something you can do. We did it in 2020 during the pandemic. So being able to step up and push money out the door to solve some of these problems can keep us from the Lehman moment that everybody is waiting for this year, which I think is really important to understand going forward. Now, we still have to be able to sell our treasury bonds to be able to do that. The dollar still has to retain some of its strength. And so far, that's been true. Treasury bond auction that just happened recently here went quite well. So those are things you watch for in these particular programs. But it's also happening outside the U.S. Because I've heard a lot of talk about China being the big problem for the world, mainly because of their real estate sector. But China has started to do the same things with some different bailout programs and what have you. I've been hearing a lot of worry about our commercial real estate here because of the work from home, concepts and all those things that are happening. Again, that could be a big issue, but next year's a presidential election year. If there's something that's going to happen next year, it might be taken care of. Who knows? I'm not sure of that, but those are things you have to consider in today's world, is that there's a government action that can happen to offset some of these projections that people are making. Because that was the big projection. We were going to raise rates too much. Something was going to break. We were going to end up with this big fall, really looking at what happened in 2008. Okay, so the next thing that I think is really important here, and I've been talking about this also since 2020, is that the pandemic itself, with all the money that was pushed out and all the confinement, creates this pent-up demand, and people get out and they do things. And we have seen that dramatically. I keep thinking back to the Roaring 20s, which came after the last pandemic, and you can kind of see what's going on here. And that was one of the best 5 years in the history of the stock market. Matter of fact, I think it's the second best 5 years history of stock market outside of the 1995 to 2000 realm. And so when you look at that, you say, okay, this is a really interesting time period that the past data doesn't really show anything, because we can't really look at data from 1918 and have any confidence in what's going to happen there. It's a different world, especially in the investing arena, with the number of households that now invest and what have you too. So I think that's another important point, is to remember that we're coming out of a pandemic. It changes the scenario. There's an offset to these rate increases, and that's people's willingness to spend money. And it turns out they have more money than people thought. A couple new reports that have come out, and households and businesses have more cash on hand, so to speak. But they're also willing to use credit cards or what have you to go out. We've seen credit card debt go up too. But again, it's sort of, live for the day mentality that's happening that I think is really interesting. And, we're just beginning that, in my opinion. So we'll see how this plays out as far as that goes. So those are the key things that I think are important to remember. They're for being positive, what the government can do. All of them stay with the primary trend. It's a pent up demand. All of these things turned out to be the reason that we are almost at an all time high. Didn't quite get there today. We were just 4 points away from it yesterday. Retreated some today. I think that's okay. I think in order to get through this big barrier, sometimes you have to get things on sale. So maybe things come down a bit and everybody gets excited, and then boom, that's the catalyst that can kind of push you through there. And then oftentimes you'll end up with, a pretty good run after that. So now looking at next year, it's kind of fascinating. We know that the Martin's wide breadth thrust indicator flashed a buy signal in very early November. It only did that 18 times since 1945. 100% of the time, the market was up. 12 months later, 23.4% is the average. So that's pretty good. So if somebody asked me about what's going to happen in 2024, that's one of the things I think about. Another thing I think about is that we had a huge November. When you have a really big month like that, you tend to have some follow through, and the average return after a big month that's close to 9% return over the next 12 months is about 14.7%. So not bad. And then, of course, when you break into a new all-time high after having a retreat like we've had, and we've got 13 of the last 14 are positive in the next 12 months with an average rate of return of 13.9%. We haven't broken into a new high yet, but we might next week. We're really close. So we'll see how that goes. So, those are all those things are lining up for 2024. Throw in a presidential election year, which is typically a very good thing for the market. And just keep all of those things in your back pocket, so to speak, when you're looking at what's happening next year, in terms of, are we still in a primary uptrend, and do we still have all these other data pieces behind us historically? Because we're going to hear all kinds of bad news. That's just the way it works. It's how people think, I suppose, and it's what they're interested in terms of looking at that type of data. So anyway, that's my outlook for kind of next year, things that we learned from this year. I think this has been a really interesting year, very gratifying to see how this all played out. Super excited to see where things are going to go next year also. I do think artificial intelligence is going to be a tailwind for the stock market. We're just beginning that. Reminds me a little bit of the dot-com time frame, when kind of it was a little quiet at first. It was the big companies, the NVIDIA type companies in this particular case with AI that are having the big run. And eventually it starts to morph into other areas and smaller companies that start going public, that kind of thing. That can, raise the entire market actually, which is what happened in that 95 to 2000 run, which was the best 5 years in the history of stock market. So again, I'm not saying all these things are going to happen. I'm just trying to point out the stuff that's positive, so you can kind of keep that in mind when you get barraged with all this negative news. So I want to thank everybody so much for watching all these videos and for commenting and liking and subscribing and all the things that you've been doing. And I really appreciate it, and all the nice comments during my appointments about them too. So I hope everybody has a really great new year, and I'm looking forward to a short little vacation here. I'll be back to do this video again on Thursday of next week. Talk to you then. Thank you very much.